Okay, welcome everybody. Thank you for joining us this afternoon or evening, depending on your time zone. Welcome to the second webinar on the Taxonomy-Aligning Benchmarks. We hosted one this morning, which was a great success. We had several hundred people joining and asking very good questions. Just to let you know, this is a series of webinars that the EU Platform on Sustainable Finance is running to improve the engagement and also to get some feedback on its work. And in this case, the consultation on the Taxonomy Aligning Benchmarks is open until mid-March. So please do check it out and do submit your responses and your opinions and your feedback on the report. So today we have Professor Andreas Hoepner, who is joining us to actually explain what the TabX and tabs are for, what the purpose is and how to use them. And also he is very kindly agreed to stay on and discuss some of your questions that you might have. And this is a unique opportunity to ask about the things that you've been wondering about or what you have heard on this webinar and to get some direct clarifications. Andreas is a rapporteur for the platform, and he is also one of the most distinguished professors on financial data. So it's very exciting to actually hear from the source about this particular piece of work, focusing on the taxonomy aligning benchmarks. So Andreas, please, let's get started. We might have more people joining in a few minutes since we're only 1 minute past the hour. And just to let everybody know, since we are running this as an interactive webinar, if you want to speak, all you need to do is to raise your hand. There's a little hand at the bottom of your screen, and we will unmute you. The other option is to use the chat. It is enabled. We will see your questions and we will take them one by one, and we will answer all of them. Or alternatively, you have even third option where you see 3 little dots. You can push the button and there's a Q&A part where you can submit your question that way as well. So thank you everyone for joining, and Andreas, the floor is all yours.
Thank you very much, Linda. Thank you very much for listening in. I know we had about 300 signed up for the evening slot, 500 for the morning slot. So whoever is there can ask questions. This is very much about a Q&A and a joint discussion to basically for you to ask about tabs. If you have related questions to us, if there are other things, please also don't shy away from asking them. And so it's really the ambition is to have a joint discussion. Otherwise, we could likewise just do a video. So what are we focusing on? We're focusing on the EU regulatory response to the climate change challenge. In particular, we're focusing on the climate change taxonomy and taxonomy-aligning benchmarks. Taxonomy-aligning benchmarks are, if you want, so the sequel to Paris-aligned and climate transition benchmarks, which you may know. I'm Andreas Hoepner. I'm heading the data science hub for the EU Platform for Sustainable Finance. And I will explain everything first from the perspective of Paris-aligned and climate transition benchmark, because that's easier to then understand how a taxonomy-aligning benchmark will work, and then coming to taxonomy-aligning benchmarks. We'll take questions at once in the middle, just to make sure everybody is fine with the basics, and then at the end of the webinar. And a lot of people, as you can see here, need to be thanked for the excellent support they've given to the project. So first of all, where are we? When we invented Paris-aligned benchmarks in 2018, 2019, we were facing a world where only number 1 was basically there. So we had climate benchmarks that were 30%, 20%, 40% better than market, but that's where they stayed. They were kind of sitting on the right fence, but they weren't moving from that fence in any meaningful direction towards net zero. So the benchmarks were better than the market, but they weren't better than they were necessarily themselves last year. So what Paris-aligned benchmarks introduced to the existing number 1 point here are points 2, 3, 4, and 5. First, an actual self-improvement, so reduction of greenhouse gas emissions year on year compared to yourself last year. A clear focus on net zero greenhouse gas emissions by 2050. A full integration of scope 3 greenhouse gas emissions, specifically mining and extractives are integrated from December 2020. All heavy industries from December 2022, and all industries including financials category 15, for instance, from December 2024. And also a clear focus on the precautionary principle in greenhouse gas data estimation. Inevitably, some companies do not report greenhouse gases, or they only report incomplete greenhouse gases. And perhaps many other parts of the EU regulation very clearly say you have to apply the precautionary principle. So if in doubt, err on the side of the planet, not on the side of commerce. That means if you need to estimate because the data isn't there, overestimate somewhat. That will motivate the company to report. That will reduce the risk that you have an estimated number that suddenly becomes a lot larger when it's reported. If the data is poorly reported, overestimate a little. And if the data is accurate, take the actual data. Furthermore, we are very encouraged, very encouraged, in fact, by the success of Paris-aligned benchmarks. EU ISFC Article 9.3 is specifically written for Paris-aligned benchmarks. The AUM by last summer was over 100 billion. Now it's over 150 billion already. We have 100 plus indices, ETFs, in-house mandates, and so forth. And so it's very encouraging to see that overall conceptual success. And pretty much PAPs and CTBs, what they're currently delivering is a sufficient financial performance in terms of return on investment, return per unit of risk, and a sufficient greenhouse gas reduction in terms of real impact outcomes. So both the ROI as well as the RIO is particularly good, or at least decent. What are we targeting? We're targeting from the IPCC special report, the 1.5-degree trajectory going down to net zero by 2050. And that's very much the reason this particular curve here is 7% year on year. That's where the actual number comes from. We have two types of benchmarks, one that uses exclusions and one that doesn't, because the market is very divided between on that particular question. Some people want to conceptually exclude, others don't want to exclude. They may want to underweight, they may even do zero weights, but they simply don't want to conceptually exclude. So we have two versions for that. Both versions target the IPCC's 1.5-degree target with no or limited overshoot, the PAP more on the no overshoot side, the CTB more on the limited overshoot side due to a slower decarbonization. CTB then basically propose a minus 30% decarbonization to start with. The PAP is a minus 50% decarbonization. They decarbonize emissions divided by valuation, so greenhouse gases divided by enterprise value, including cash from an investor perspective. And they do that at a 7% speed year on year. In fixed income, they can also decarbonize absolute emissions. Then we have two provisions to prevent greenwashing. One is that in the equity indices, there's an allocation constraint that you basically cannot move out of heavy assets. So if the benchmark universe had a lot of heavy assets in it, 50-55% heavy assets, then the actual PAP had to carry the same heavy assets. This means that a PAP will decarbonize within heavy assets and within light assets pretty much separately. So when you're taking money out of certain very heavy assets, you move them into the more efficient, the better industrials, the better telecoms, and so forth. You're not moving them out into consulting companies. And then we have the exclusions. There are no exclusions on the CTB, but there are exclusions on the Paris-aligned benchmarks, and these are firms that are excluded with more than 1% revenue from coal, more than 10% revenue from oil, and more than 50% revenue either from gas or from inefficient electricity producing with more than 100 grams of CO2e per kilowatt hour. That's the basis for PAPs and CTBs, overall 150 billion in just about 3 years raised for this concept. This is a minimum requirement, so any index provider would normally put on advances beyond that. Some go straight from -10 rather than -7%. Others have used scope 3 from day one. Again, others overlay with other scales of screens. So it's really the minimum that anyone can exceed upon. But if there's any questions on this concept, because that's very important that we are leveling on this before we go to the explanation of taxonomy-aligning benchmarks, please, they are very, very welcome. Linda, I know we had about 10 questions in the morning at this stage. Can you see any questions?
I cannot see any yet, but I think in the morning we started getting them maybe a little bit later. So let's see, maybe we have a slightly more silent audience in the evening.
Okay. Then I'll continue. So in the same scheme, I shall present taxonomy-aligning benchmarks. So first, on taxonomy-aligning benchmarks, we have two climate imperatives. So we focus on the IPCC 1.5 degree with limited or high overshoot. Notably high overshoot here because we won't have an initial decarbonization threshold. So we're not starting from -30, -50, we start from ±0, as was demanded in stakeholder feedback, for instance, from some members of the Net Zero Asset Owner Alliance. And so we're not being able to say that this is necessarily no overshoot or even limited overshoot. This is most likely high overshoot. And then we focus on increasing the green capex. So the actual green capital expenditures, the key transition metric, we're aiming to basically increase their green capex 5 percentage points year on year. So in essence, globally speaking, we may have 2% green capital expenditure. We go 2%, 7%, 12%, 70%, 22%, 27%, and so forth. So it's very much the ambition here to get that green capital expenditure increase year on year so that we get the grid green, essentially the overall grid that we all draw the energy from. If we get that green and some other investments made, of course, as well, then ideas like green hydrogen will become a lot more realistic and so forth. I'll come to that in a minute, Marie. There is just no other way than allowing overshoot if you do not have an initial decarbonization. So we don't have an initial decarbonization here. So we're not -30 or -50 to start with. You can read the documentation from the Net Zero Asset Owner Alliance, who specifically requested that. They specifically requested a version of the index that starts at ±0. And if you start at ±0, you decarbonize 7%. And you allow for decarbonization holidays. So the idea is basically that if you have 100% green capex, you would only have to decarbonize 0%. If you have 50% green capex, you only have to decarbonize 3.5%. Then you will need to tolerate some level of overshoot. Of course, the IPC itself tolerates limited overshoot. So it's great to see the questions coming. Please keep them all coming. I will continue to explain the 5 concepts and then go through all questions step by step. So now we're increasing the 5 percentage points of green capex year on year. And that particular increase allows for a decarbonization holiday. So the idea is on a PAP alone, if you're decreasing 7% year on year, that's great. But what if I put all the money in a wind park or a solar farm? I develop something new. So in that sense, I may create new emissions. It doesn't seem realistic that I can be on a stringent emission reduction diet at that point. And so that's where that decarbonization holiday idea comes from. So you put 100% of your capital expenditures, meaningful capital expenditures, in green, then in this year you have to reduce 0%. You put a 50% in green, then in this year you have to reduce 3.5%. And it's hugely important to understand here that last fiscal year's capital expenditure is a wonderful measure because it's both forward-looking, it's capital expenditure is supposed to drive the future, as well as its evidence. It's not just lip service. It's not just something that one Shell CEO says and the next Shell CEO takes back. It is actually evidence. You have spent the money, you can't walk that back. So we're focused on last fiscal year's capex, and that last fiscal year's capex greenness is our measure that we want to drive up. And that will be drive up 5 percentage points per year. So in Europe, we're at 12% right now. That would be 12, 17, 22. Globally, we're more at 3%, that would be 3, 8, 13, and so forth. And so the next question is then, what is meaningful capex? Because if I look at the relative of the green to the total capex, I could have just a, 200,000 euros in a giant company, and I could be 100% green, but not a meaningful number. So that's where the capex to price ratio comes in. So in essence, if the nominal capex attributable to the asset class is more than 1% of the price, then we say it's meaningful. That means that pretty much all heavy industries are covered. But likewise, if consulting firms, say I'm talking from Dublin, say Essentia would have the will to put in 3 straight wind turbines just outside the building, and that would be all the capex they did, and that would be 100% green, that wouldn't be anywhere meaningful to the value of Essentia, so that would not be covered. And so the beauty here is that we have 2 types of securities. We got capex securities, who are supposed to green, and we got non-capex securities, and they decarbonize just as normal, 7% year on year. So that 7% year on year is the decarbonization that we expect of everybody, except for those that have proportional green capex. They get a holiday for that particular fiscal year only. So if you have 50% green capex one year, you get a holiday. If you get 0% green capex next year, you wouldn't, and the other way around. So that means that all management teams that really want to put their money where their mouth is, they can just make 100% of their CapEx green and they'll get that decarbonization out of it. But that does mean that they wouldn't be able to spend any CapEx on non-green things. And of course, some management teams may not want to do that and therefore not necessarily have their money where their mouth is. So then we have two further features against greenwashing. We have an exposure constraint for CapEx securities. So if 60% of my universe are CapEx securities, then the TAP and the TAPEX will also have to have 60% of CapEx securities. And we have activity exclusions. And they have internally caused the most debate because activity exclusions essentially are always heated discussions. And here they're a little bit more complex. So in essence, you're excluded if you're exceeding the 1% threshold from coal on both revenue and CapEx. You're excluded if you exceed the 10% threshold from oil on both revenue and CapEx. And you're excluded if you exceed the 50% threshold from gas on both revenue and CapEx, which in turn means if your CapEx is below the threshold, although your revenue is above, so historically you've been a not particularly good company, but in the future you actually really invest in green, for instance, then you're fine. But you have to report that yourself. So footnote 3 here says very clearly that precautionary principle applies. So if a company is not willing to report disaggregated CapEx, then they're out as long as the revenue is too high. But if a company is willing to report disaggregated CapEx, which is any oil and gas company, so if they can prove that they have less than 50% in gas and less than 10 in oil, then they would be qualifying for the TAPEX. So the Taxonomy-Aligning Benchmarks with exclusion. And so here, really, it's an offer to any company to participate if they actually put their money where their mouth is, if they're following. We're looking at last fiscal year's green CapEx. That money is spent, you can't get it back, so that's a definite, not just a lip service, and it is forward-looking. Really a beautiful measure in many ways. Additionally, we do recognize, and there may be a few US investors on this particular webinar, we do recognize, of course, that green CapEx data is fine for Europe. 1,968 companies had to report so far, of which 1,600 did, and about 800 reported non-zero values, so it's pretty good. You have companies like RWE, about 13% green revenue, 83% green CapEx by EU taxonomy, so we actually see companies reacting. But at the same time, outside Europe, while we do have green taxonomy numbers for American, Canadian, Mexican, Chilean, South African, British, Swiss, and some Asian countries, but it's not that many companies. So in essence, if companies elsewhere in the world would like to participate in this and show that their CapEx is green, but they do find the taxonomy, in particular, its no significant criteria, rather laborious and rather related to EU legislation, then we're saying for half of the 5 percentage points that you're increasing, so for 2.5 of that, you actually have the ability to take an estimate from a vendor that confirms that taxonomy significant contribution is fine, minimum social safeguards are fine, but the vendor can basically estimate the last DNSH that otherwise is hard to see. So you can be there if you're basically hitting everything except for that very last DNSH. So simplifying that approach a little bit to open up in particular to non-EU companies. So that is the structure of TAP and TAPEX, and visually speaking, it means we have a decarbonization strategy like in the PUP, and we're greening the CapEx 5 percentage points year on year, targeting 100% green CapEx prior to 2050, well ahead, so between 2040 and 2045. This is a global chart here. If we looked at an EU chart, we would be starting around 11, 12, 13%, depending on universe. So at this stage, I see that we triggered a lot of questions, which is brilliant. That's exactly why we do it. So let Linda moderate, and we have a whopping 40 minutes left for questions. That's great.
Yeah, wonderful. I think the timing is perfect. So Leo has the first question, so we'll take that one first. Does the 7% year-on-year reduction limit ability for benchmark administrators to select assets that may be decarbonizing at a different rate? So is there a need?
The answer to that is no, because the benchmark administrator decides the weights And so in that sense, it's no problem if some companies decarbonize 3% and others decarbonize 11%. You basically can either average them, or you can give the one with 11% more weight than the one with 3%. So the 7% enables a benchmark administrator to pick any company, even some companies theoretically that increase. They'll just have to make sure that overall the weighted average carbon intensity is reducing at least 7% year on year.
Perfect. Because then he's following it up with another question: if there is a need for greater nuance in the methodological requirements, for example, accounting for constituents in high-emitting sectors with credible transition plans, or constituents operating in emerging markets. But I think you pretty much answered that question more or less with
I'm happy to come to that as well. The answer is no. First of all, we don't have that in Paris-aligned benchmarks, which have done really well. And second, any considerations when you start to treat sectors differently is a very, very slippery and dangerous slope. First of all, the question is, what is a sector? Nowadays, one company, one sector is completely unrealistic. Like most companies trade in a whole range of individual activities. In the platform currently, we're working on a pure play imperative. So essentially every country should be broken down, at least analytically, to pure play activities that you can actually analyze them. Ideally have a pure play matched to a legal entity identifier. So, this is a legal entity, subsidiary that does this activity. And that then allows to look at a more detail. But any considerations that are based on pretty much insufficient sector classification as we see them is an enormously slippery slope. The benchmark administrator can simply decide, this is a minimum standard. If they prefer to give certain companies a 9% requirement and others a 5%, that is fine. It's up to the benchmark administrator. But certainly the planet has to go down 7%. So that's the baseline expectation for anyone.
Fantastic. We actually have a question that I think is either the same or very similar from the morning session. So the TABEX, so the exclusion, taxonomy-aligned benchmarking, does not include among exclusion criteria companies whose main activity is electricity production, despite the fact that the carbon intensity of electricity production cannot be compatible with the Paris Agreement targets above a certain GHG intensity. Those issuers are excluded from the EU Paris-aligned benchmarks and also from the revised version of the French Socially Responsible Investing Fund label, which will be applicable from March 2024. We have noticed that these issuers were first included in the list of excluded activities in the draft TAB and TABEX proposal, and later removed in the final version of the document. So this person's wondering why.
They must have seen the platform version.
Yes.
So the simple answer to that is that the utility criteria above 100 grams of CO2e per kilowatt hour is very, very complex to measure and document the capex on. So while it is clear that you can report capex on gas, oil, and coal, there will be certain parts of capex that you frankly can't relate directly to the actual threshold. So it's a very complicated way to go through it. And in principle, this is a minimum standard. So anyone who wishes to exclude utility providers can, of course, do this. But as a minimum standard, it's difficult to ask for a metric that is frankly unreportable in real cases. We'll get into the same issues that some of our DNSH criteria on taxonomy have that are not reportable. And you can do capex on a utility where the capex is good, but not directly related to your grams per kilowatt hour.
Great. I think there's also another interesting question about the capex and subsidies. So does the scaling green capex take into account subsidies?
Subsidies or subsidiaries?
Subsidies.
Subsidies. So this is the green capex as per last year's, in most cases, IFRS report. So if that green capex is subsidized by your government or by anyone else, that's fine. We have no opinion on how that should be financed. You don't get a bonus if that green capex comes from a green bond, and you don't get a malus if it comes from a subsidy. So it is the green capex that you put forward in your financial report as an issuer. And in many ways, I guess, if subsidies support it, then that's a good thing.
Fantastic. I think it's also interesting that Ambra has another question. So these are more detailed questions from somebody who I believe probably has read the report and the legislation very carefully. Categories of pre-filters are not detailed enough. For example, it's not clear what should be included in tobacco activities. So, for example, do the same filters apply as per the EU Paris-Line benchmark as stated in Article 12 of the Delegated Regulation 2020-1818?
Yes,
Cultivation and production of tobacco.
The pre-filters are, and you can see that in, let me take a step back. Anyone who wants to ask very detailed questions, please feel free to reach out on LinkedIn. Very happy to discuss them. The short answer here is yes. The pre-filters are supposed to be absolutely equivalent to PAPs. You can see that in the latter part of the draft where the language is a bit more legal.
Exactly. I think there's also a very, again, more of a legal question around social filters. So it's about UNGP, so the UN principles versus UNGCs. So I believe that this question, again, I would argue that maybe that's something that
I can take that up. So the overall platform usability report of October 2022 already recommended to move from the UNGC principles to the UN guiding principles on human rights. There is a pretty close overlap. The guiding principle on human rights probably somewhat more extensive. And so in that sense, it is a move that goes pretty much throughout the platform documents, that is supported, pretty much decided by platform leadership. And so we're moving from UNGC to UNGP. My technical understanding is that it makes it slightly more extensive, no big change really. But if anybody has a different view, please do feel free to reach out. Very happy to discuss in detail.
Fantastic. Thank you. Now let's move on to, I think, more general questions, which I think majority of the audience will be keen to hear your answer to. So there's a question about why is the sole focus on CAPEX? And why is there no recognition given to turnover and OPEX, which are equal metrics under the taxonomy regulation?
Yeah, that's easy to explain. So CAPEX is forward-looking, is a decision of management. Everybody can realistically go 100% green CAPEX if the will is there. So it is absolutely commercially realistic to go 100% green CAPEX. You just have to have the will to not do the other CAPEX. Divest the activity, do whatever you like with it, just don't give it CAPEX. So that means it's fairly realistic that we reach 100% green CAPEX well ahead of 2050 if we really want to try. Now, with revenue and OPEX, that's frankly impossible. On OPEX, there are certain ways to spend your money that just ain't green, but you still have to do it. On revenue, you have existing business lines that may not be green. To entirely get rid of all of the non-existing business lines while building new business lines that may not generate that much revenue yet is unrealistic. So we can target 100% green CAPEX. We can't target 100% green revenue, 100% OPEX. Revenue is backward looking, OPEX is somewhat backward looking, CAPEX is forward looking. CAPEX criteria, CAPEX data is a good bit better. CAPEX and DNSH is a feasible proposition. Revenue and DNSH is a pretty tricky proposition because the DNSH criteria are written well later than most revenue lines were developed. And so that's why we're focusing on CAPEX. We really want to shift the future. We're not intending to be too much backward looking here.
Perfect. Thank you.
It's all about transition. Transition is CAPEX, transition ain't revenue.
Well, this actually links very nicely to two questions that are interlinked. So it's focused, the questions are focused more on the transition of certain assets that I guess are very tricky. So the first question was about, is it not more effective to green or transition companies that are exposed to coal, gas, and oil? So why are they excluded? And the second question is about ESG data providers that are not publishing data on coal, oil, and gas based on CAPEX. So in this case, should
let me take the first question
there be
first.
revenue data considered. Yes.
So from a transition perspective, coal, oil, and gas are excluded from a PAP, not from a CTB. Coal, oil, and gas are not excluded from a TAP, and they're not excluded from a TAPEX if they want to transition. We're only excluding coal, oil, and gas firms if they do not want to transition. So if you're an oil and gas firm and you want to transition with sufficient will, meaning your CapEx for gas is less than 50% and your CapEx for oil is less than 10%, you're in. In this activity exclusion, you're only out if you violate both. So you can carry, let's take an example here, you can carry 20% oil revenue, 80% gas revenue, and virtually no green revenue at this stage. If you decide to put 50% of your CapEx, or say, if you decide to put 41% of your CapEx green, 49.9% of your CapEx into gas, and 9.5% of your CapEx into oil, you're in. So we are basically stretching out the hand to everyone who actually means it. And that's why I strongly recommend to look at the green CapEx last fiscal year numbers, because they tell you if a transition plan is credible, not the language in the transition plan. They tell you if management means it. That is the one indicator that determines the credibility of a transition plan, not the 123 pages of prose.
I mean, that's a very interesting conversation about the transition, and do people actually invest in the transition? Do they walk the walk, so to say? So this is one way how you can really assess the transition plans, which is going to be a very hot discussion going forward.
That means you mean it. If you don't have the CapEx, you don't mean it. If you're in a non-CapEx industry, okay, we can talk about it. You're not that relevant anyway for transition, but we can talk about what is the best indicator there. But in a CapEx relevant activity industry, if your CapEx doesn't signal transition, you don't mean it. No matter how long your transition plan, no matter how many external green stamps, no matter that 99% of your advertising budget is green. You only mean it if your money is where your mouth is.
Agreed. Great. So we also have a question about how does the EU taxonomy-aligned benchmarks fall within BMR?
The EU taxonomy-aligned benchmarks are currently consulted by us as a platform, deadline March 13th. Obviously, they're not yet in BMR as PAP and CTB are. Likewise, obviously, we're going to have an election in June. So subject to the election not doing some very unexpected things, I would hope that we would see them in BMR at some point after the election.
Great, thank you. So I believe we have another 2 or 3 questions, which is great. So please keep them coming. I think that's the Q&A is always the most interesting part, since we get to dig into more detail. So Jessica has a question about, again, linked to transition, that we are currently looking into assets which are part of the transition in the current economy, meaning assets we will still need tomorrow, but currently don't qualify or not considered as green. However, we still need them as part of a future EU taxonomy once they have invested in mitigating their impact as much as possible. So what is your view on this? That essentially what Jessica is saying, that she feels that currently these type of companies are being disregarded as future green. So I think it goes back to your transition point, I believe. That
So the view is pretty clear. So if a company is making credible investments, not just credible noises, actual investments to be future green, which means they have CapEx declared green by the green taxonomy, that green taxonomy stretches across pretty much any sector that is CapEx relevant, then they're in, and they're absolutely in the system. If, however, they either are in an activity that is just not that CapEx related, or their CapEx isn't in any way green, then we would expect them to decarbonize 7% year on year. So this is a broad benchmark for any activity, from consulting to utilities, from chemicals to some sort of software tech that isn't really related to the taxonomy. So anyone basically can be in there, and everyone can do their part. Some companies just decarbonize, and other companies that have meaningful green investments to make can make these and will get a decarbonization holiday in return for that particular year where their capex is green. So really, it is it combines both imperatives. The number one imperative of the Paris Agreement, which is to decarbonize. Without decarbonization, we get nowhere. And the number two imperative, which is to green the economy, so that we actually make sure that the decarbonization will be accepted, tolerated, even encouraged at the ballot box.
Thank you. I think that it's also marrying the macro and micro, because Paris Agreement set out the macro idea that we need a transition and this is what we're going to do by a certain date. This is actually helping very realistically to do at least something a little bit more science-based and measure the success of the decarbonization.
Very good comment, Linda. On any benchmark administrator in the audience, and I saw some names already, that's essentially what benchmark administrators do here. Yeah. They marry the macro and the micro. They take an economy view, and then they, in their own rules, which they may put on top of the actual minimum standard that we're proposing here, they decide how to translate the macro into the micro. So the weighting decision by any benchmark administrator would be the micro. Our concept would be the macro.
Good. So let's move on. We have more questions flowing in. So I think that it's interesting. Robert Adamczyk, one of the platform members, is also saying that how we define transition will be key. We should work more on this. It's true. There's currently a lot of discussion as to what does transition finance and transition look like, but there's also a lot more work happening on platform level and elsewhere on this. So there is somebody else also asking, for companies that issue bonds, such as pension funds, sovereign wealth funds, or financing vehicles, how should one apply CAPEX-based exclusions?
Such as pension funds that issue bonds?
Yes. So I believe that there's a bit of a mixture between things here, because I don't really...
Maybe can the individual just rephrase that question, which actor we're talking about?
Yes.
So a company...
So I guess it's maybe pension funds dealing with investments by companies that are issuing green bonds. I would imagine that would be the question.
So maybe... question could be restated, otherwise I will try to answer with a sensible answer for the broad direction. So this is on security level. So you could, as a company, ring-fence a legal entity, issue a security that has a certain CAPEX purpose that is unrelated to the rest of the legal entity. So you would, in essence, if you have a particular green bond that is ring-fenced in the legal entity, so money can't leave the legal entity. Yep. Ring-fencing in accounts doesn't work anyway, but at least you have to assure ring-fencing in the legal entity. Then you may get a different perspective on this than the rest of the structure. So in essence, as you would note here, it is CAPEX securities, not CAPEX companies. So individual securities, green bonds, sustainable linked bonds can essentially deviate in their criteria from the remaining securities of the same issue. To come to Robert's perspective, while we have discussions on what transition is, one thing is pretty clear. If your green CAPEX is not larger than your green revenue, then you're not transitioning. And your green CAPEX divided by your green revenue is a pretty good indication of how much effort you're transitioning. And so we're producing that data now, which I think is a fairly nice way of looking at, are you actually transitioning or are you not transitioning?
Indeed. Robert's following up also with a point about DNSH on minimal safeguards, the social ones, and how there should be maybe more clarity about this. And so it could be potentially more than just compliance with member state laws. I don't think we're going to go into the discussion.
And Robert can ask that in the platform. We don't need
exactly the potential social.
Let's focus on non-platform members here.
Exactly. So I think there's also an interesting question about how will the EU taxonomy potentially apply to the construction sector. This is something that we hear a lot, since there's a lot of assets that need to be transitioned. And somebody's also asking, for buildings which are EU taxonomy aligned under acquisition and ownership, would these be considered Paris aligned, or where is the divergence in PAB and EU TAB? So the divergence between Paris aligned benchmarks and TAB.
So the Paris line is on decarbonization. So that is focused on the first objective of the Paris Agreement, decarbonization. The EU taxonomy is really focusing on the second objective, what is green, right? It's not focusing on what is brown or how to reduce emissions. So in that sense, they're unrelated here. The taxonomy-aligning benchmark offer a version where the taxonomy, whatever state it is, and every development will follow, is basically fused into a Paris-aligning benchmark structure, tolerating high overshoot because we're not having a minimum initial decarbonization, so slower in decarbonization than PAP or the CTB, quite a bit slower, but still actually decarbonizing 7% year on year while giving a little bit of a decarbonization holiday to those with green capex. So possibly overall might be 6.5 or something. But it's a merger of both ideas here. This also means, which is quite important, right now the green capex data for the taxonomy is climate change mitigation or climate change adaptation. As soon as biodiversity, circular economy, pollution prevention, and so forth are ready in water, they will also count on the green capex. So we already have a biodiversity link in this particular concept that actually will also count, and we are indeed on top of that exploring nature protecting benchmarks, gender enhancing benchmarks, water pollution reducing benchmarks, water consumption type benchmarks.
Very interesting. All the potential benchmarks. So
the concept works. It's a sequel.
It makes sense. It's all about also meeting the preferences of what people want to finance. So you see a lot of rise of thematic funds as well. Right. So for fixed income, bond, private debt investors, does the use of proceeds need to align with the green capex activities? So it's from how you do.
From the benchmark perspective, no single security needs to align with the green capex. You just don't get the decarbonization already if you don't have it. So overall, you have to increase 5 percentage points year on year across all the securities which are in the benchmark, but no single security needs to necessarily align, right? Mm-hmm. It's an overall value-weighted benchmark concept. Single securities can either contribute to decarbonization or they can contribute to gradually increasing their green capex 5 percentage points per year. So as said earlier, no one needs to align. Obviously, it's preferable if it were to align.
Of course. I think Glenn Anderson, actually, from Fidelity, has a very interesting question that I'd like to take next. So more broadly, what about capex metrics for financial institution bonds? How would you classify capex for a bank? Does this mean Finns do not have a place in a tab despite having GAR? So it's linked to the green asset ratio.
Wait. So banks, anyone is in a tab, either on the 7% decarbonization side, in a tab. Anyone is in a tab either on the 7% decarbonization side, or they are based on the green capex side and green capex increasing side. Now, banks structure an enormous amount of securities, and this is per security. So any bank that wishes to structure green bonds, or a sustainable linked bond, or a hybrid of both, sustainable linked green bond, where the condition would be that 10% of the money would go into green capex as per EU taxonomy on companies they lend to, is absolutely, in fact, the whole concept based on security creates a strong incentive for any bank and any banker here on the call today to think about structuring a refinance security for the bank itself, where the conditions of the TAP or the TAPEX are very much mirrored, and then carries the same concept into private markets by giving loans to companies that can basically back them up with green capex. So bank securities will absolutely be there. If general purpose securities of each and every bank will be there, that of course depends on the bank.
Great. I think that the banking sector is a very interesting example of...
It's a huge opportunity here with sustainable linked bank bonds. Sorry.
Oh, absolutely. It's also very interesting to see, because we have a lot of conversation with different banks across the wider European different regions. And I think that the issue here is the slow uptake of these particular instruments. So as long as the financing flows easily, people don't always realize what a good opportunity they might be missing, especially for the future of their financial mix. Right. So there's also a question, another one from Amber, and I think we have another few coming in, which is great. Amber is asking, how have the capex to ratio minimum threshold of 1%? How was that set? This 1% capex to ratio minimum threshold.
Very happy to. And by the way, so first of all, I'd be very pleased if anyone who's interested adds me on LinkedIn, because I don't really know who I'm talking to. You kind of listen to me, and happy to discuss all these questions in more detail. There seem to be a lot more questions that we can cover in the next 15 minutes. So the 1% ratio, first of all, how exactly is calculated? So let's take a company, hypothetically, 600 million debt financing, 400 million equity financing. So, and let's say our capex is 100 million, and so then 40% of that would be on the equity side. So 40 million would be equity. Then depending on where the market cap sits, let's say the market cap with the 40 million here sits at, let's say, 1 billion, then we would have 4% capex to price ratio. So that 1% threshold came from two considerations. A, we basically, it has to be meaningful. So lower than 1%, frankly, isn't meaningful. 0.1% is super low. But as soon as we raise it, we did test 3%, 5% and so forth. We're going to lose a lot of companies, especially on the equity securities, as soon as the market is a bit of an uptick. So it is absolutely intended that if you have a tech company where 99% of the share price is basically goodwill, so in essence, the share price to book value ratio is 100 to 1, more or less, that shouldn't be in there, because investing money in that company means you're only buying goodwill, you're not really impacting the capex. So in essence, what we are saying is you invest in a company from an impact perspective, there are three things. Sorry, you invest in security, let me be precise. You invest in a security from an impact perspective, there are three things you may buy. You may buy goodwill, you may buy within the book value status quo, or you may buy within the good value future investments. And so if these future investments part within the book value is actually more than 1%, then at least you have an impact here on the future, no matter the asset class. And that is the same for public equity, private equity, fixed income. Obviously, in fixed income, you're not going to buy much goodwill. A lot of that will be put straight to the book value. But on the equity side, you, both in public or private markets, you may end up buying a lot of goodwill, effectively companies that are valued a lot higher than what the assets or the capex would show. And so what we're interested in is to say that at least 1% of the money you're investing in a particular security triggers through to the part of the company that is future investments. And I think that's a pretty reasonable threshold. 0.1% really seems a bit low. Then companies could sneak in with some acrobatic accounting. 5% simply, frankly, was too high. The universes would get too small.
Thank you. I think that's a good point about the acrobatic accounting. There's all sorts of things happening. Leo has a very interesting question, actually. It's all about the transition planning and net zero commitments. So Leo's question is, did you consider any requirements for constituents to also have a transition plan? So for example, accompanying efforts to align and increase capex at the activity level with a wider entity level plan that would then contextualize these efforts? And would it then make sense to overweight these constituents in the index versus those that may have activity level capex commitments, but no greater plan in terms of the entire entity?
The answer is clearly no. Transition plans are massively in favor of large companies. Transition plans cost money, 30,000, 100,000, 150,000. Large companies can foster that much easier than small companies. We're making huge efforts in the platform to not in any way discriminate against SMEs, and we're very concentrated on this. The idea here is that we have a metric, green capex, that says if the money is where the mouth is. So in essence, that metric says a lot more than any transition plan. No matter how many green pictures, no matter how nice pros, no matter how consultants were hired. So the green capex metric decides if the company is credible, not the plan. Now we have that metric. Why should we give any consideration to the lengths or the structure of a particular plan? Of course, it's good if a company has a net zero target that does include score 1, 2, and 3. That would be very good. and that would be very recommendable. It's good if they have a 2030 target that aligns with Decision 17 of the Glasgow Climate Pact, so in essence minus 45 by 2030. All of that are additional information that any benchmark administrator, if they wish to, can add on top of it. But the actual core metric remains, are your capital expenditures green? And if they aren't green, then one CEO may have made a transition plan and another CEO is just about to walk that back. So we are really looking for actually committed cash, not just lip service.
Thank you. I think there's an interesting question about ESG scores and by banks. So this is an ongoing discussion. There are methodologies, and I've seen a few projects that are working on this. So there's actually something like that already exists. But here the question is, would the CAPEX green as a key climate transition considered within the ESG score established by banks for clients? So corporates applying for credits from banks. If yes, how would you see the impact of that in the near future once banks would apply this? Would that increase the credit exposure of banks or reduce it? And or would that create a gap and lack of future investments within the sectors? So essentially, would applying greening create a credit crunch?
So already, when the PAPs were developed, some banks had internal green supporting and green penalizing factors. Sorry, green supporting and brown penalizing factors. So they were already changing differential rates depending on the greenness and the brownness. As just mentioned, it would be, in my view, quite clever by banks to issue sustainable linked bonds or sustainable green bonds that basically connect the financing to applying essentially TAP or TAPEX rules, and then investing at least 5 or 10% of the actual cash in green CAPEX at the borrower level. So that would trigger straight through to the actual borrowers. In case the bank got better refinancing conditions on this, they may pass on some of that to the borrower. That would commercially be very clever, something that they can put money in that is better presented to investors. So the idea of a green supporting factor or a brown penalizing factor or both, of course, has been circulating quite a lot in the EU. If that ever will be formal policy is well beyond my pay grade, but it is something that implicitly has already been triggering through in the banks. And of course, that does make sense, right? The externalities that come from brown activities are considerable. Those issuers that have previously not been having to pay for the externalities at all, having to pay a little bit more refinancing costs, still cheap for them compared to paying for the full externalities, most likely. But that's in essence what one is looking at here. So, and keep in mind, this is CAPEX. Any issuer that currently runs on brown revenue can put their CAPEX into green. It's up to them. It's the willingness of the management. And the number is on the financial account. You can see it. Are they for real? Are they not for real? Right? It's absolutely known, not even an open secret, it's known that certain oil and gas companies at times had 99% of their marketing budget green and less than 1% of their CAPEX. So if they actually mean it, then they can put less than 50% of the CAPEX in oil and less than 50% in gas and less than 10% in oil, and they would qualify. They'll not be able to do that with the revenues, that's understandable, but they can do that with the CAPEX if they actually mean transition.
Yeah, so that's the one part they have control over.
And they have control over straight away. That's something they can change at the next management meeting.
So we also have a question that is a bit broader and from the investment side. I think Jaime from Chile is asking more about technological solutions for verification of bottom-up information about investments and assets and companies that I think we won't tackle on this particular webinar, but I do believe that there's more and more opportunities there because there is also a business case. So I believe that from what I've seen, there's been a huge increase in the number of companies trying to provide these solutions. So I think that eventually will also be solved as a macro issue. So Jessica has a point about our impact fund has defined a 7.5% year-on-year reduction for the companies, the investees. Here, they leverage sustainability-linked loans. However, the underlying assets in the portfolio are not EU taxonomy eligible. So what Jessica would like to hear is, it would be interesting to know what current talks and developments are happening to tackle a situation like this, and what you could imagine happening in such a situation.
So, I mean,
So, for example, she's mentioning, just to finish it, she's also mentioning later that they do receive a few points discount on the rate, but it would help to have it clearer for banks that not being EU taxonomy aligned means the asset is not taking part in this big decarbonization effort.
Yeah, so 7.5% of it is great. So if that's the weighted average impact fund, then you automatically are essentially qualifying for a TAP or a TAPEX. If you have initial decarbonization of -30 or -50, then it would even be good enough for a CDB or a PAP. So that's brilliant. It's very difficult to answer without knowing the underlying assets. So if you could reach out on LinkedIn, very happy to pick the question up offline. Otherwise, I'm massively speculating.
Wonderful. So that's actually, we have tackled all of the questions, which is impressive, because I think for the first one, we slightly ran out of time. If you have any last minute questions, please do put them in. Okay, we actually do have from Islam, as per his understanding of your answer on the CAPEX and the effect within the ESG score, that corporates have room for changing the percentage of green CAPEX, which is a way out to reduce it. So the following question is, would there be a stricter limit that could take creditors out of the eligibility from taking loans from banks, which might affect banks and its credit portfolio and lose clients? Is that something within the draft of EU regulation that could take us to a drop within the banking sector and probably the economy widely? So I believe that's the same issue, that would there be some sort of credit constraint to the market due to this greening effort?
So on the taxonomy-aligning benchmark, with or without exclusion, and let me say this again, no one is out. Even the exclusions allow any company that wants to be in to just hit the CAPEX threshold. So in essence, anyone can be in if they have sufficient will to transition. And that's basically what it comes down to. It's as easy as that. Does a company in their future investments, capital expenditures, really put them into green activities or not? And the EU taxonomy covers pretty much any activity that really is CAPEX intense. Anything else can just decarbonize 7%. It just doesn't have so much CAPEX. And so in that sense, it's fine. It's not really needing shift machinery or other aspects. And overall, companies can be in if they're willing to actually make their CAPEX green. On the TAP, if that particular effort is too complicated, especially for non-EU companies, they can essentially maybe not be just exactly there on one DNSH criteria. On the TAPEX, it's the full compliance with the EU green taxonomy. And so it's really up to every individual management team. If they're real about transition, we understand revenue and OPEX may not be as green as someone would hope to for a while. It's really difficult to actually change them fast. They're like big tankers in many ways. But CAPEX is something that you decide fresh every year, pretty much for next year. There isn't much stickiness to that. So it's up to the will of the management, and it's up to anyone to encourage management to do that, and to any analyst or investor to look at what is the CAPEX percentage green compared to the revenue percentage green, of course, for CAPEX intense securities. So especially for transition, where any sector that really matters for transition, any activity that really matters for transition is a CAPEX activity in many ways, there is a beautiful opportunity here. Last fiscal year's green CAPEX, I cannot stress that enough, is the best number for the credibility of the transition plan. It is forward-looking, yet it is committed. It can't be walked back, not just lip service.
And in the same vein, I believe that the banking question, there's nobody mandating banks to apply certain type of criteria of how they lend. That is actually also a board level management, etc., decision in terms of what kind of stricter criteria or rules banks internally apply to how they finance, what loans they give out, which businesses they refinance or lend to. So there's one last question that I would like to take because I think it's actually very interesting and might be something that people are wondering about. So we have 1 minute left, but Tariq is asking, is the EU taxonomy looking at measuring CAPEX being incurred by suppliers of a company? Is CAPEX discussion all about scope 1 and 2, or do we also take into account scope 3?
At this stage, we looking at the CAPEX of the actual issuer. Of course, certain vertical decisions may imply outsourcing to supplier or insourcing again from a supplier. We are very aware that the scope 3 logic is hugely important. You may have seen in SFDR that there is sovereign scope 3 straight applied, and we're working on that in detail. Likewise, we are likely going to include a scope 1, 2, 3 logic in our water benchmarks. So basically with water and scope 1, 2, 3 for the taxonomy itself. That might be a step too early. I mean, it is a quite intense and rather complex instrument. So we're focusing it on CAPEX. We're focusing it on the future thereby. That is all very helpful. At this stage, we're going straight into a supplier's CAPEX. I think that would be academically, theoretically interesting, practically overkill.
Thank you very much. That was I think your answers have been very comprehensive and very easy to understand. So thank you very much for that. Just to let you know, the consultation on the tabs is still open until 13th of March. So please do submit your feedback and ideas. And also don't forget to connect with Andreas to follow also his work and developments in this space. And I've also put a link to the platform's newsletter and its LinkedIn page where you will get updates, because there will be one more very interesting webinar coming up later this year, also about the tabs, which will present the additional final insights linked to this work. So thank you, everyone. And yes, you will get a recording and pending Andreas's final confirmation, also the slides. So you will be able to take your time and connect with us and ask follow-up questions if you do have any. So thank you so much. Thank you, Andreas. This was great. And have a lovely evening, everyone.
Thank you very much, Linda.
Thank you. Bye-bye.